Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. For this segment, we're going to talk about the volatility complex. Steve Sosnick, chief strategist at Interactive Brokers, is noticing a pattern that in the Nasdaq-100 Volatility Index that investors should be aware of. Steve, it's great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. It's always a pleasure to join you.
Yeah, and you know what? Volatility really has been the name of the game over the past couple of months, especially over the past couple of weeks in our trading sessions. And you're seeing inversion throughout the Nasdaq-100 volatility complex. What does that mean, and what does it mean for investors?
Well, when we look at the volatility term structure, and it's something we've talked about before, and probably you'll hear me talk about it plenty more again, but it's something I always keep an eye on. And that is, if you graph the implied volatilities of the at-money options, you could take your pick whether you want to do it with NDX, QQQ. They're all in about the same place because markets are efficient. And normally what you would see is near month implied volatilities, the nearer the term, the lower the implied volatilities, and they tend to rise as you go out. That's the normal state of affairs pretty much for any futures curve or forward-looking curve. It's because of the interest rate cycle. It's that standard in futures. In futures lingo, we call it contango. What we're seeing now in options land is backwardation, where the front month or the front week options have higher implied volatilities than subsequent months and weeks. And we're seeing that pattern persist. It's been persisting for quite a while. Typically, what that tells you when any future is in backwardation, an option, the options curve being no exception, is that there's a shortage. There's a shortage of available, whatever the available commodity is in the short term relative to the longer term. What the market's telling you is there's kind of a relative shortage of volatility protection in the short term. Now, some of that is related to events that are what we're going to call the known unknowns. I mean, first of all, the geopolitics aside, we have payroll numbers on Friday. We have a Fed meeting on the 16th of March, and we have basically triple witch, a quarterly expiration on that Friday, which and those have returned to some volatility, by the way. And so it's understandable that we would see this inversion to some extent. Normally, that is what I call a necessary condition for a market putting in a bottom when there's a bit of an inversion. But I also say that it's not a sufficient reason. Just because it's inverted doesn't mean we're going to rally. And what I'm seeing now is it's a fairly shallow inversion. When I looked at it earlier today, let's say the front month implied volatilities were about 30, 31. The outer month volatilities were about 28, which is really not all that steep. When we think about some of the real cathartic times in the market, we're talking, let's say, about 40 in the front and 20 in the back, that sort of thing. So it tells me that the markets still have a lot to grind through before we see the end of this back and forth that we're seeing.
So, Steve, it sounds like, and you've written about this in other areas, that once you see that particular inversion scenario, it's not enough to be a signal for one way or the other, because to your point, longer term vols didn't actually get it right in the beginning of the year. Absolutely.
The longer term vols actually, it's interesting because for a market that's so actively traded, it gets it wrong a lot. And I've noted to you earlier that separately before we spoke, that at the beginning of the year, the March volatility assumption was about a 21. The NDX QQQs were trading with about a 21 implied vol on the at-money options, and those same options now are about a 30. And so that is in volatility terms, that's a big miss. Right now, so that's going to be very interesting because let's say as we get out to May and June, we're looking at 28-ish, something like that. The question becomes, do we sustain that? At year end, my call for 2022 was going to be expect more volatility. I didn't expect this because I thought it was going to be more Fed driven. But I do think that it's reasonable to think that we're going to see more volatility in 2022 than we saw on average in 2021, because we have so much less clarity from the central bank, let alone the geopolitics. But does the market have it right in anticipating that we're going to be sort of similarly volatile for the next few months? That's really the question that traders have to reckon with.
Right. And Steve, it's so interesting when we talk about predictions for the year. Let's look at 2020, right? As a baseline there, nobody in their December and January pieces was talking about COVID. And it wasn't even part of our vocabulary at the time. Going to 2022, geopolitics is always going to be somewhere as a risk parameter within our prediction notes. But as acute as Russia and Ukraine, I'm not sure anyone would have assumed that in late December, January, unless you're focused specifically on that region. This seemed to have taken the market by surprise to a certain extent, because prior to the Ukraine-Russia headlines, it felt as if the market was somewhat stabilizing, and we got it. We knew hikes were coming in March, perhaps even 50 basis points, sort of settling in with the idea 5 to 8 for 2022. But it really is interesting to see, as much as we look at the market as a forward discounting mechanism, how sometimes it doesn't always price things in correctly or even thinks about certain scenarios.
Absolutely. That's one of the fascinating things, because on the whole, I really do respect the message of the market and its ability to get things right. But markets get blindsided all the time. And you just gave some great examples over the past 2 years. 2 years ago at this time, we were just starting. This was when the markets were starting to fall a little bit. We're starting to reckon with the idea of COVID, which, prior to early 2020, no one had any idea what was going on except for a few epidemiologists. And in terms of the geopolitics now, this thing escalated quickly. Slowly but quickly. We started hearing about the troops and whatever else, but then it escalated in a quick way, and the sanctions stuff over the weekend, really escalated quickly. And it's not clear to me that the market has fully reckoned with what happens when you sever the world's 11th largest economy from the global financial system. And that'll be something I think we'll be dealing with over the next few days, because I find it unrealistic to think like we got it over with over the weekend and move on. And this is what makes markets fun, is there's
Right.
always something being thrown at you that's a bit unexpected. But that's why you have to be cognizant of your risks. You have to hedge when necessary, or sometimes before necessary. Think about where your hedges are, or think about your risk. Always be thinking about your risk parameters, because this stuff sneaks up on you in the worst possible times, in the worst possible ways, and you can't always do what you want to do or need to do at the time that you need to.
Well, and Steve, I'm so glad you brought up that point, because just before you and I went on, we saw the flash on CNBC that the New York Stock Exchange and Nasdaq placed regulatory halt on Russian stocks. So if you either held them longer term, kind of betting on an energy balance here, or if you were trying to trade them near term based on a resolution or not, certainly a risky trade, they're halted. What happens now? How do you even think about what they'll look like if and when they do reopen?
This is tough. I was actually, I was curious to see how they would do this today, because I figured they would probably try to muddle along and let these things trade. But ultimately, it's tricky to trade ADRs and the like when you can't convert them, because we don't really know what's going to be fungible in any normal sense. Can the banks actually create and redeem ADRs? Can we create and redeem ETFs based on said stocks? It's probably easier to put them in regulatory halt, because the regulatory issues are so extreme. But this is why there's an old adage: trade when you can, not when you have to. And I think it's very important, that this was driven home these couple of weeks. And that is saying that, you can't, while markets are typically liquid, while markets are typically responsive, while especially for smaller investors, you can almost always get done what you need to get done, but it may not be at prices or times or levels that are the levels that are favorable to you. And you can't assume that liquidity will be there. And that's why, that's why we talk about, options all the time. You and I, we don't talk about them as speculative. We talk about them as a part of a hedging strategy, and let's call it part of a balanced investment diet, so to speak. And this is where this sort of stuff comes in, because you have to be managing your risk all the time. And it was easy to let risk management slide over the last couple of years when we basically just went straight up. And now risk management is going to be, it already has been, and it's going to remain a paramount consideration over the coming months.
All right, Steve, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.